Morning, guys. Appreciate everybody to come in already due to the hopefully good coffee and breakfast. We will start day 2 with one of the, I think, most exciting and probably interesting topics these days, tokenization. We have a great panel. I want to give everybody outside because they're all finishing the breakfast and don't want to rush anybody because it should be fun and a joy. Maybe another minute. And then I welcome our panel to the stage, which includes Coen Ter Wal, director from AFME, Alex Wu from the Stellar Development Foundation, and the notorious Peter Kerstens from DG FISMA, to hopefully enlighten us about tokenization, what it is, what it does, what it can do, what it cannot do, and kick it off as a starting point for today's program, because we'll talk a lot about it. We'll talk about the potential for the Capital Markets Union later today. We'll talk about it from an academic, economic perspective, and in a lot of other shapes and forms. We have a lot of other nice panels on privacy today and sustainability, a lot on, as I said, tokenization, a lot of great speakers elaborating it from the leadership positions, from our sponsors on their views on MiCA, their views on the market, on NFTs, from perspective from the US. So a lot of things looking forward to. And without further ado, I want to ask you guys to please join us on panel or on stage for a panel. Please welcome our panelists. You want to sit there? Here you go. So, topic of the day is tokenization and what Europe can do about it, or hopefully not against it, but for it. And for that reason, we have our digital finance expert from DG FISMA here to tell us what can MiCA do for it? Can MiCA do anything for it? Have you thought about it? And if you did, what is this thought? And please share it with us.
Geez, that's lots of questions for an early morning. But
it's early morning.
Have we thought about it? Yes, we've thought about it a lot. Can MiCA, and I'll tell you what our thoughts are, or at least my thoughts. Can MiCA do something for it? No, because MiCA only covers digital assets, crypto assets that are not financial instruments. There is an ecosystem of that, and if you look at current global market capitalization, we're looking at about 3.5 trillion. These days, trading volumes in the plus $200 billion a day. Yesterday was $300 billion. So this is not insignificant. But I believe, and this being blockchain for Europe, this not being crypto assets for Europe, but blockchain for Europe, we really should focus on the potential of blockchain technology. And if you see what is the potential of blockchain in financial markets, I think the potential is absolutely enormous. And it will pale whatever has been going on in crypto markets into insignificance. Because the size of traditional financial instrument markets, equity markets, debt markets, derivatives markets, is many, many, many multiples of what the size and the trading volume of crypto assets. When we proposed MiCA back in 2020, we also proposed a DLT pilot regime, which was for the use of distributed ledger technology in traditional financial markets. And we faced an awful lot of resistance and opposition to this. Many of my colleagues in the Commission thought this was absolute and complete blasphemy to involve blockchain technology, the same technology that's used for crypto assets, into financial markets. But also, and of course Koen wasn't at AFME at the time, big financial industry players were not at all enthusiastic that we were going to allow or wanted to experiment with DLT use in financial markets. And that explains why the DLT pilot regime, which in a way was an attempt, is so restrictive. There's so many limitations to it, both in asset classes, in volume you can transact under it. But wisdom comes with time, and now 5 years later, it's the subject I personally am solicited on most. And I want to plug here something, and Koen will like this. I would recommend all of you to read the AFME, GFMA, SIFMA reports on DLTUs in global capital markets, because you can see what potential big traditional financial industry sees in DLTUs. And if these people see enormous potential, both in revenue generation, but in particular in terms of efficiency and cost saving, then this is an opportunity that we should not miss, especially if we want to build a capital markets union. And I believe that capital markets union will not be if it is not digital. So maybe, we've been trying for 10 years to build a capital markets union with, I would say, relatively moderate success, because our member states are not as enthusiastic about it or as committed about it as we would want them to be. But maybe digital assets and the interest that exists in industry around digital assets and tokenization and distributed ledger technology allows us an opportunity to build a capital markets union, at least around digital assets. So I hold great expectations. The big question is, what should we do to help this along? I hope that the answer is nothing, or that the answer is don't stand in the way. We can do that. We'll do our best to not stand in the way. But if there is something that we should do for this potential to be unlocked, all of you have to be very loud and clear, not only to me, but to my bosses, saying this needs to happen for this potential to be unlocked. And then we will act. I know, and Koen will probably talk about this more, is that a number of conditions that have to be met for tokenization of financial instruments to really develop are not within the remit of the European Commission. It's more central banks who are responsible for it, member states sometimes. But where we as European Commission can act, we should. But for that, we first need to know what it is we need to act on.
Thanks, Peter, for that. Koen, AFME is one of the most important and probably well-known trade bodies in the traditional finance industry. And I know that you did some work on tokenization. Can you maybe explain which perspective AFME and the traditional finance industry take it? What you're looking at, what you're excited about, and maybe elaborate about the report that just came out.
Yeah, no, very happy to. And I think, to Peter's point about should the Commission do nothing, probably there is certain things that they should do, but we'll get to that. I think, and to your point as well, it starts with sort of a vision and sort of an understanding of what is the potential and what is it that, why are we doing this? And it's true, I think the financial markets have sort of been on a journey, so to speak, over the past few years in sort of trying to understand how DLT can fit into capital markets, but also I think, and this is also what we put in our paper, it starts also from the real economy, because yes, maybe capital markets will dwarf crypto markets, but ultimately, obviously, the real economy also dwarfs what capital markets or guides what capital markets can do. I think in general, the view is that DLT does have the potential to be quite transformative, both in the real economy and in capital markets. If you look at the real economy, obviously the big feature, so to speak, of DLT is the ability to represent many different assets, different types of assets in a single database, on a single ledger. And that, of course, then unlocks a lot of vast economic potential for economic innovation and economic efficiency. And we're seeing that, right? We're seeing Industry 4.0, and we're seeing energy tokenization and real estate tokenization, all of that stuff. So the capital markets, of course, are a part of that journey. It's also true that DLT, in and of itself, if you look at capital markets as a standalone use case, can really transform capital markets, and DLT can play a massive role. And that goes to the CMU that Peter mentioned. I think DLT can have a great potential in building up capital markets in Europe by enhancing liquidity or making liquid or making tradable assets that currently are not, by obviously enhancing the efficiency in the capital markets, the traditional capital markets, which in places are not very efficient, particularly on the post-trade side. So through automation of settlement, through automation of onboarding, through automation of asset servicing, all kinds of processes that can be automated. issuance that can be automated, and that of course also then increases access, for instance, for smaller corporates to come into capital markets to raise working capital through tokenized receivables or to issue debt instruments in a way that they currently cannot. So if we look at the possibilities, I think they're quite substantial. And if we look at the union piece of capital markets, many of you will be familiar with the fact that in Europe currently capital markets are very fragmented. And really, if you look at settlement in particular, it's sort of centered around national clusters, national intermediaries, trusted intermediaries. DLT, of course, opens up the possibility of linking all those different pockets through a distributed network and in a distributed network. And that can greatly enhance efficiency, greatly enhance liquidity. So there's many possibilities for DLT, and there's great potential both in the real economy and in capital markets. The question is, how do we unlock that? And I think we'll speak to that a little bit more later on.
Thanks for that, Koen. Alex, you're spending a lot of time in the US, working for one of the innovators in the space. Can you maybe elaborate a bit what's the perspective from the US, both on what you do in the US as an innovator, but also like when you look at what other jurisdictions, and maybe Europe in particular, think and do about it?
Sure. So in the US, the narrative around crypto and the use of blockchain digital assets is highly politicized, so it's a little bit different from kind of how things work in the EU perhaps. But kind of with the recent political changes with President Trump and kind of the new very pro-crypto Congress, I think that's kind of the signal that kind of like these larger regulated institutions, one of the signals at least that they're looking for. In the US, it's really driven, the tokenized real asset issuance is really driven by these like kind of larger financial asset firms like BlackRock, WisdomTree, and so on and so forth. And so this is kind of one of the signals that they're seeing, and the hope is that this will kind of build on the momentum. I mean, even in this current political environment, tokenization is, at least in the US, is one of the few topics that traditional finance, digital elite, crypto native, and regulators are all willing to come together and have a conversation about. And so the expectation is that you're really riding this in the new kind of political posturing. And I can talk a little bit about kind of what we're seeing, at least in the US. Most of the issuers, I think notably, are like BlackRock, WisdomTree Financial, Franklin Templeton, and to a smaller extent Paxos. They have tokenized like money market funds, which are very relatively safe, very vanilla instruments. They're highly liquid. Government securities are kind of overnight lending agreements, and so they're simple, but then they're effective. And I think they show the value of kind of what Koen has mentioned about what DLT and what transferring assets and kind of shares of ownership of shares like on a blockchain can bring. And I think it's hard to find quantifiable data on that. I think the narrative of speaking about these operational efficiencies is quite common, and I wish I could kind of shed more light on that. But like a couple weeks ago, there was a conference, and an individual at Franklin Templeton mentioned that they're able to save, like really a significant amount, kind of recording shares of ownership and transferring funds on chain. But not only that, there are more secondary order effects when it comes to post-trade, like reconciliation and remediation. And so there are kind of these immediate benefits, but there are also kind of long-term effects that that can kind of snowball down the road, right? And so that's the hope, and that's the expectation. And in comparison to the EU, like you just mentioned, I think that in the US at least, there are many projects that are already at scale that are available to a wide investor base, both retail and institutional. But in the EU, it's a little bit more so in the experimental phase. But it's also at the same time a bit more involved. Like you had mentioned, the EU DLT pilot. The US doesn't really have kind of like a sandbox at that level. But there are also kind of these one-off experiments like ABN AMRO, like these banks are doing them. But I think it's just at a different phase. It's not really like a competition in that sense, but that's just kind of where things currently stand.
Thanks, Alex. Koen, when you look at the global market, and not just Europe, and capital markets are global, like the digital assets markets, and I think what blockchain and digital assets bring to the table in this context is that it's becoming more easier to be more global. So when you look at everything that we just discussed and the comparisons that have been made between the US and Europe, which is always a thing, it's the closest ally we have, and what do you think are the biggest upsides and the biggest obstacles that we have, right? Because one of the things that we think about, for example, is the whole value chain ready for tokenization, right? Do we have the right rules in place on the issuance side? Do we have the right rules in place for the clearing side and the settlement side? Is it something that we can do from day one? Or do we have some readjustments to make or reinvent the wheel?
Yeah, and I'd say actually, if you talk about global, the technology may be global, but regulation is not, and that's where perhaps part of the fragmentation may remain. If you talk about benefits, and we just talked about it, I think they're multiple, right? They have efficiency, pre-trade, post-trade, liquidity. They're sort of across the board, but I think they will probably materialize in slightly different ways for different asset classes. In certain asset classes, definitely liquidity is a big potential benefit, but it may materialize in different ways. For some asset classes, it may materialize in sort of outright secondary market trading. In others, like fixed income or fund shares, it may be more that enhanced collateral management, enhanced repo, enhances liquidity in a more indirect way. So that will materialize differently in different parts of the capital market, but the benefits are definitely there. In terms of the obstacles which you asked about, I think, first of all, we have to say that the technology, we've done the proof of concept, we've done the experiments, we've done all of that, and the technology works, so that's the good news. I think the challenge now is very much how do we scale it, how do we unlock those benefits at scale and make it economically viable. And the biggest challenge there is obviously you have to build an ecosystem, right? There's a lot of different players that have to come in order for that network to work, to scale, to produce those benefits. And that's where I think that's the phase that we're in right now, in Europe, but also across the world. And if I sort of had to point to sort of specific obstacles there, I'd say there's sort of three areas. There's cash and collateral, there's the market itself, and then there's regulations. So if you look at cash and collateral, obviously in a capital market, any transaction, whether it's a security transaction, a cash, FX, whatever, there has to be a cash leg to settle that transaction. And probably, in DLT-based capital markets, we'll have a variety of cash options, stable coins, tokenized deposits. But of course, central bank money is really central to capital markets and probably will remain so just for economic reasons. So it's very important and very positive that the ECB came in, did the trials, did the experiments. You could see an enormous boost in market interest, right? We had AFME, we sort of track DLT-based bond issuance. We went from less than $1 billion in March to over $3 billion now worldwide, and most of that, or a lot of that, it comes from the ECB trials and experiments. So it's really important, therefore, for the ECB also not to lose that momentum now, and to in our view, come out with a solution, an operational solution in the short term to really show that commitment to central bank money settlement for DLT-based capital markets. It's very important. Similarly, collateral. For any investors, if you want to bring in investors at scale, DLT-based securities have to be able to be used as collateral in monetary policy transactions. It sounds quite boring and dull and technical, but it's really key for investors. So I think that's the first challenge that we still have, and that sits more with the central banks to some extent. The market itself, obviously, still very fragmented. A lot of different DLT platforms, walled gardens, etc. So the challenge for the market is really how do we link all of those different platforms over the next couple of years? We're beginning to see that both through interoperability and linkage, but also we're seeing collaborative projects now emerging, mutualization of DLT platforms. So that will have to continue over the next few years. For us, as AFME, what's really important as well is how do you bring in the investors? And that ultimately means bringing in the custodians, right? They have to be able to onboard to different ledgers. And currently, that's a pretty painful process. It takes time. It takes a lot of legal fees. So we're working with our custodian members to say, okay, can we streamline that process, make that easier? Because that's, again, another big step that the market itself has to make, I think. And then finally, there's regulation. You mentioned it. I think we've seen, particularly in Europe, we've seen a lot of positive steps, right? We've seen MiCA, which provides certainty as to the delineation of crypto assets and as to the regulation of stablecoins. So that's very helpful. The pilot regime was mentioned, and I think at national level we've seen certain initiatives as well. So that really, particularly in the early stages of DLT and capital markets, really show that policymakers were committed to this. I think the success story is in a way that the market has moved beyond that phase, beyond the proof of concept, experimental phase, and now we're sort of standing at the cusp of scaling. And that's where I think the regulatory framework has to sort of catch up. And so we've made some proposals to change the pilot regime, to really enable at-scale issuance through the pilot regime and make that possible and viable and of interest. And then we talked before about how you could link the different settlement pockets that exist in Europe through DLT in a sort of distributed network. That probably requires an update to the CSDR. And we've made some proposals for that. So I think it's really helpful, it would be very helpful if at the EU level policymakers were to say, okay, we support this vision of a DLT-based capital market. and we're willing to put out these proposals that make the regulatory framework sort of future-proof in that sense. So there's still quite a few challenges: cash, the market, regulation. I think the upside is there's definitely momentum. So we're seeing progress in all those areas, and that's very heartening for sure.
I think we spend a lot of time now talking about the financial elements of it, right, of capital markets and so on. But there's a world beyond that, and you know, Stella is a Web3 company. Can you maybe talk a bit about what you see in the market in regards to tokenization that is not actually, let's say, capital markets financial, but more like real-world assets tokenization, and what you get excited about?
Sure. I mean, I think that what's happening on Stellar is very largely financial use cases, to be quite honest. But the real-world assets component of it, I'll touch on. I think is interesting because, and as mentioned, these are real-world assets, so they do require regulatory clarity. And I think that that is what a lot of issuers are looking for to kind of move forward and to kind of grow their projects. But also kind of to step back and to think about this more broadly, like tech integration is difficult, and kind of upgrading existing systems that kind of process like systemically important transactions, like this should not be something that's easy and should not be done something overnight, right? There's like a lot of the narratives of like operational efficiencies. Like the assumptions that undergird this is kind of like disintermediation, right? And I think we know that, and these third parties kind of along this like flow of funds, they're all really important, and I think it's a matter of understanding how like public blockchains can like take on these roles, but and augment them and not just kind of like you remove them. And so I think that there is like a larger tech neutral conversation to be had that is just outside the financial services use case that also needs to kind of be maybe reminded in within the Web3 community. But also I think you were kind of alluding to like the savings and investments union that the EU is trying to build, right? And so like tokenization can kind of broaden that investor base. So like on Franklin Templeton, their minimum investment amount, at least on Stellar, is $20, we know, which is quite low. Wisdom Tree traditionally faces institutional investors, but their tokenized assets are available on an app to retail investors. So right, this is kind of really broadening that investor base and improving liquidity. And but I think another assumption of kind of having that market, that single market component of using DLT is like, one blockchain, right? If you have kind of multiple DLTs or multiple blockchains, then it also is the kind of another fragmented universe. And so the question is like, where is the responsibility for kind of interoperability? Is it on the infrastructure level? Is it on the asset level? So there are other more questions that kind of the Web3 community can kind of help answer. And lastly, kind of to your point on the asset user or the asset holder side is kind of really about usability and utility. Like what can they do with it? And so how do you benefit from kind of the real-time auditability, transparency, verifiability of public blockchains? But also, for example, Franklin Templeton actually now allows with their tokenized money market fund, peer-to-peer exchange for institutions. And so if you can use these tokenized funds as collateral, then and institutions can exchange, directly. There's added benefit to that too. And so I think it's really kind of stepping back and thinking about it from a more macro perspective of how the technology can intermediate rather than just kind of brute forcing kind of the tokenization narrative into like where it's possible.
Thanks, Alex. Peter, when you look at tokenization, where do you draw the line for maybe yourself or FISMA or the Commission between financial applications and non-financial applications, right? And I'm asking this because we had a big debate about NFTs back in the days on when they become financially regulated instruments and when not. Because theoretically, you could, once it's digitized, you can put everything on a trading platform, right? But sometimes it might be something that is not traded on a large scale, although very valuable, but easily and fastly traded, right? But on the other side, it's a fungible asset that still might not be needed to be put on a trading platform, right? So there's this, I want to say, gray zone on when it probably could be considered a financial instrument. Where would you draw this line? Because it's still a debate that I think hasn't been settled.
Yes, it is a debate, and I think it's a bit of a pointless debate. That's why we don't draw a line, because we don't regulate, bar from stablecoins, the asset as such. We regulate in MiCA the services provided to the asset. And so the question is not, is this crypto asset a financial instrument or does it have a financial use? The question is the service which is being provided a service of a trading venue, a portfolio management service? Is it a brokerage service? Is it a custodial service? All of these services are financial-like services. Whether that token is a Bitcoin or that token is an image of a monkey, in a way, shouldn't matter that much because we're looking at the kind of services being offered. Is it a trading venue? And it is undisputable that a trading venue, which is a price discovery place, is a financial service. Whether you are doing price discovery for Bitcoin or you're doing price discovery for paperclips, in a way it doesn't matter. It's a trading venue. And that's why and I will certainly not get drawn down the line of drawing a line as to where do financial instruments stop. What I do see is that as you can tokenize more and more assets, that's great, but an asset which is very illiquid and unmovable and untradeable can become very movable, very liquid, and very tradable once you tokenize it because it becomes very easily transferable. Take a painting. I have a Monet, I wish. It's very hard for me to transact that Monet. But if I were to tokenize that Monet, I could very easily move it because I can move the token to someone else. And so by tokenizing, you make the asset useful for financial applications, for financial services, for financial uses. That doesn't mean that the asset itself is a financial instrument, but the service provided to it is a financial service. And that's what we regulate.
Just as a follow-up question, and you know that I asked you that 5 times, and I'm curious if you give a different answer. If you were marketplace, like I don't want to call anybody out, but I think there's a big American company that is probably known for this, where you put your stuff that you want to sell when you don't need them anymore, and you put tokenized assets there. Would this become a financial platform or a trading platform under MiCA or MiFID or anything, because they do now tokenized assets there?
Well, I hope if they've got good lawyers, they can maybe find the way to weasel themselves away from the regulation. But I think the chances that if they start offering a platform for either brokerage or the trading venue activities of tokenized assets which are covered by MiCA, I think it is very likely that if they were to provide these services in the EU, that they would need a MiCA license. Of course, they can try and get away with it and not do it, but then it's at their own risk, and they may face enforcement action from one or the other member state. And if that happens, they shouldn't come to us and say, oh, please protect us from member state X or Y, because they are taking enforcement action against us. I said, look, if you're providing these services, you're going to get caught. And they can try their luck in court. We're not going to say that MiCA applies. This ultimately will be a matter for the courts.
I don't know what AFME thinks about that, right? Because if you start tokenizing real-world assets, then is it in your interest that everything becomes financially regulated? Because listening to Peter, my understanding is that if you do this in a form or shape that looks like a trading platform or a trading service, then you would automatically become, at some point, in some kind of form, regulated by financial services.
I think it's part of this journey of DOT. As I said, one of the features is, of course, that lots of assets can be put on a single ledger or a single platform. The question then is indeed, how do you regulate those different assets? Obviously, regulation does distinguish between sort of financial instruments and non-financial instruments. So to that extent, certain assets are regulated. They're regulated in different ways. I think you could make this argument as well around DeFi. You know, a lot of the DeFi platforms, are they decentralized? Should that be a consideration? Should that be a criterion? It's not a criterion in MiFID, for instance, right? There's no such thing as a decentralized trading venue in that sense. So is that the right criterion to use? a lot of the decentralized instruments that are being traded, decentralized insurance, for instance, is that insurance or is it a derivative? Really, if you look at the specifics of the contract. So I think there's lots and lots of detailed discussions that you could have. Probably at some point you do have to draw a line between what is the financial sector, what is the real economy. That's true. But yes, it's true that DLT sort of starts to blur that line in many different ways, both in terms of centralization, decentralization, in terms of the types of assets that are traded. Indeed, focusing on the services, you sort of avoid the discussion around assets to some extent. But I think it's an ongoing discussion.
I mean, the name of the panel is How Europe Can Lead the Way on Tokenization, right? So when you look at it from an industry perspective, Alex, and Peter mentioned that in an ideal scenario, we don't have to do anything because everything's perfect or everybody's happy, right? But sometimes there's the questions like, do I rather have clarity or bad regulation, right? And the question is, how do you make that work? So would you rather go for bad regulation in order to have clarity, or you rather want to go for no regulation and happiness in this, as Peter would say it?
I'm not going to take that bait, and I'll say both are good. But I do think that, like, from an infrastructure, like a tech infrastructure perspective, kind of what both folks have been alluding to is, like, you have to take a look at the underlying asset, right, and like kind of what that looks like. And these assets all have existing marketplaces, whether it's like a financial instrument or a Monet or what have you, right? And so the tech is neutral, and you're kind of using the tech as a wrapper to move these traditionally, illiquid or kind of difficult to process like assets, right? And I think that's what it is. And I think, but yes, regulatory clarity is obviously important. That's not to say that current regulation is bad. It's just that emergent technology, that's just kind of how it is, right? It's moving a little bit faster than what regulation and like kind of what regulators can interpret. So yeah, I mean, I think that for these kind of like larger systemic issuers who banks or non-banks or non-financial or non-financial, they're focused on like risk mitigation, and like that's one of the variables in their calculus, right? And so yeah, I think the short answer is yes. I mean, I think both of those are important and valuable.
I just say, I mean, certainty. The question is, what certainty do you provide? Sometimes the certainty is, if it's the certainty of the graveyard, it's quite difficult. It doesn't really, it's not really, I think, what anybody's looking for. I think what we're looking for more would be both, from the regulatory perspective, is the ability to give space to different business models. Maybe if you look at the financial services regulation, and having been in that space myself, I know this is very tempting, is to sort of, you try to take something you understand, and you can see and hold, and that's tangible, and then you write the regulation that's specifically targeted at that. And the problem with technology is lots of different business models are emerging. And I think the real crux is, the real conundrum and difficulty for policymakers is to how do you write regulation that allows for those different innovations to take place while still maintaining a sort of a level playing field between different entities. And we're having those discussions, as I said, in cash with central bank money. Well, what should the ultimate solution look like, the ultimate cash solution? You immediately get into a discussion around, well, what should the ultimate infrastructure look like, the ultimate DLT infrastructure look like? Because that sort of, obviously has to interplay with that cash solution. But maybe you cannot decide that right now, because in 5 or 10 years, the market will probably be completely different, right? Same with what I mentioned on CSDR, so the settlement regulation. Right now, we're used to having centralized security depositories where the accounts are held, where the securities are held. That's what the current landscape looks like. If you want to move towards something that's more distributed, even if it's not fully decentralized yet, but it's more distributed, then probably all those different services provided by a single entity today can be provided by different entities working together. That means the regulation probably has to allow for that different model while still making sure the risks are managed properly. So if you talk about regulatory clarity, in some cases, maybe stablecoin regulation, et cetera, very specific detailed regulation can help and provide clarity. But in other cases, I think it's more about enabling innovations while still managing the risk, and that's actually more difficult.
Oh, on this, because you said that there are two options, clarity and regulation. But you can also have regulation and no clarity. That's also possible. But also,
I'm an optimist.
But it's not because the rules are very clear that they're very enabling. Usually very clear rules are very disabling because they tend to prohibit all kinds of stuff. So it's sometimes better to have a bit of constructive vagueness that's my own view on it. But you can't have everything. If you want absolute clarity, the rules are going to be very detailed, and you're going to have lots of details that are going to hinder you in your development and your innovation. So sometimes it's better to sort of say, well, look, leave a little bit of this. But for Europe to really have a DLT-based future, or to have capital markets in Europe, is that most important, I think, is that we shouldn't be complacent. And we are. A lot of people say we're complacent in Europe because we have the most elaborate crypto assets regime, or we have the best rules, which may or may not be true. But it's not because we have the most elaborate regulatory regime that we have the biggest market. We have by no stretch of the imagination the biggest crypto market. Most of the crypto activity is not taking place in the EU. It's taking place in Asia and the Americas, not in the EU. And now every country in the world I know of wants a deep, liquid capital market. They all want that. But it's not because you want it that you're going to get it. And what we have to be in Europe very careful with is that as we try to pull together the different pools of liquidity we have in member states, and certain member states like to hold on to their pool of liquidity, they don't like a capital markets union, but they're not really sitting on a pool of liquidity, they're sitting on a puddle of liquidity, and it's not a very deep puddle. So you have to bring this together. But they have to be very careful is that there is this country across the channel where there's big capital markets that is sooner or later going to get its act together around DLT use. And then you'll see a very, very big, deep pool of liquidity across the channel, which is not very good for the EU. We'll have some mountainous country which is surrounded by the EU, which is also working on this. And it's not Austria, because they're part of the EU. I see a lot of development in the Emirates. Very interesting. I see a lot of developments in Singapore and Hong Kong. So it's very important for Europeans not to be complacent about, oh, our regulatory regime is the best. Because what good is your regulatory regime if you don't have a market, if you don't have any liquidity? We need to make sure that this market develops in the EU, and if distributed ledger technology offers an opportunity to build deeper, more liquid capital markets within the EU, we must seize that opportunity as a matter of great urgency, because the window of opportunity we have in front of it is limited and is closing.
I couldn't agree more. And before I want to ask a follow-up question, I wanted to ask anybody in the audience that would like to ask a question. We have like 5 minutes left. There you go. You get a micro.
Thank you. But what do you think about the cases when the private company creates a secondary market for their investors in form of DEX? For example, I have a private company that I tokenized. Of course, all of my investors passed KYC, and I allow to invest in my company investors that I would like to see. I mean, not from the blacklisted jurisdictions. And I am, as a company, it is my private company, I have the right to give the secondary market for my investors. In what form? Not peer-to-peer, like in traditional market where they can sell their paper securities peer-to-peer to the next VCs or the next rounds and wait 10 years to exit on an IPO, but I can create for my private company a secondary market through the DEX, I mean AMM solution, where it's a security smart contract, right? So it's smart contract, it's not the centralized venue, and it is not a automatic order matching, so it will be matched automatically in a pool in AMM. And where I will do it? I will do it on a DEX. What DEX? For example, I develop it for my own purposes. Like, it's not the Uniswap or PancakeSwap. It's my own DEX, right, that I built. And DEX means their liquidity pool. Liquidity pool means security smart contract. So, and what do you think about this case? Because I have the right as a private company to have this secondary market, but it is still like in decentralized form. And what do you think about the implication of the regulations in this case? Because if we talk about NFTs, and we talk about yesterday and in this panel as well, if we talk, for example, about monkeys, right? If I have the venue NFT market where I sell the pictures of monkeys, The regulation do not implies, because I can sell any pictures, right? But if I can stake my monkey NFT and get yields, in this case we imply the regulation because it is a financial instrument that need to be regulated. So what do you think about these two cases, about the NFTs that I mentioned and my logic, and their case of secondary market for private businesses, just for the investors that pass KYC, but not through their NASDAQ and not through the Uniswap, but through their DEX that they build for their own purposes? Thank you.
Well, if you're building a private market of debt instruments or equity or things that look like equity, and you think you're not regulated or the regulation doesn't apply to you, I fear that you're going to find yourself in front of an enforcement action by one or the other financial authority pretty soon, and you're going to end up in jail quite quickly, because this activity is financial activity. Whether it is a debt instrument, whether it's private, doesn't really matter. You're basically engaging in financial intermediation on your own DEX or not. Now, the risk of you ending up in jail in Europe is probably fairly limited, but if you were to include US investors into this, you're going to end up in jail in no time.
Yeah, this doesn't quite have anything to do with, like, again, like the technology of blockchains or using tokenization as a wrapper. It's like the underlying asset of you selling shares of your company, presumably, to like a market, whether it's like private placement, okay, maybe, but if those downstream buyers are selling them off to further markets, yes, you will. I don't think that tokenization will do anything to stop you from being regulated or investigated, to be quite honest.
In jail.
Yes, and ultimately that.
I hope that answers the question.
It's not advice, though.
There's like that's like a regulatory clarity in this case, yeah. Just as a last question, and as we have to conclude, Peter, what do you see the next commission thinking about this, doing about this? Is there I mean, it's a very early question, I know, because commission was just accepted, but I'm pretty sure there were discussions internally already on the vision of the potential commissioners in place. I hope, maybe not. Where is this going? How is an industry, an ecosystem, and I mean like the whole financial ecosystem, how can we support any of these initiatives, if there are any already? And what recommendation would you give, in which form we should do this, by when? Is there any urgency to do this as soon as possible? Or is this something that is basically like a consultation process for the institutions now, and then we can expect something in 2026 or so?
No, I think there is great urgency because the window of opportunity is closing, because the UK, Switzerland, Middle East, Asia, they're all looking at this. And the US will also start moving on this, and they may steal the cheese away from us, as we say in the Netherlands. Anyway, it's not high on the political agenda. For example, tokenization is not one of the first 100-day priorities of the president. Now, don't feel offended by this. This is a good thing. It's my experience that if you want to get something done, you do not want to be a political priority. Because if you're a political priority, everyone starts looking at it, and everyone has a view, and you have lots of cooks in the kitchen, and lots of cooks in the kitchen usually does not mean you're going to get a very good meal. So it's important that there is some momentum and that the industry stresses the urgency. Our commissioner, well, college just started a couple of days ago. She has not focused on this yet. She's not expressed a views on it. In the confirmation hearing, the issue didn't really come up, which is a good thing, I think. And she herself said she's very familiar with financial services, financial instruments, financial markets. She used to be finance minister in Portugal, worked in the industry. But when it comes to digitalization, this is an area she's less experienced in, so she wants to learn and sort of see what can be done. So this is the time for us in the department, but also for people in the industry to come forward and say, well, look, if you want to build a capital markets union, and that clearly is in your mission letter, that's what you want to do, and we've tried lots of things already, and I think it was Einstein who said that if you try the same thing and expect a different result, you're insane. So we see a lot of ideas about the capital markets union, which are the same ideas as a couple of years ago, and they failed a couple of years ago. So if they failed a couple of years ago, why would they succeed now? So if you still want the capital markets union, you'll have to do something else. So maybe building them around distributed ledger technology is a way of getting there. Is it guaranteed going to go that it will work? No. Does it offer huge opportunity or a chance? I would say yes. So I think we need a concerted effort from the industry, and I would tell everyone here in the room who wants to contribute to making this happen, keep all of the libertarian talk about economic freedom and what have you, keep that away. That's not very interesting for your case. You have to make the case as to why distributed ledger technology and blockchains are absolutely essential for building a European capital markets union, a regulated European capital markets union. That's what you need to stress. That's the momentum we need to move this forward.
I think on this call to action, we unfortunately need to end this panel, so thank you all. Please a round of applause for our panelists.